Great. Okay, thank you so much for giving me this opportunity to speak to so many of your students and potential students. And thanks so much for the wonderful introduction. And you're going to see it's this session, this special session I prepared for Admiral Markets, is more than just candlesticks. And you'll see why I'm saying that in a little bit. But just to give you a little overview, for those of you who are new to candlesticks, let me give you some of the benefits which you'll discover by the end of the seminar. First of all, candlesticks are very easy to understand. All right, you'll be amazed with how easy they are to construct. I know many of you are familiar already with the construction, but I want to emphasize, don't let how easy they are fool you, because they're extremely powerful. The main benefit of candlestick charts is you're going to be the first to get early reversals. Safety first. And what do we mean by safety first? We mean that the candlesticks will let you know which potential trades to avoid. Look, at the end of the day, it's not only how much you make by being correct, but how much you don't lose by, being incorrect. So you're going to see candlesticks help you avoid potentially bad trades. This is really powerful. I'll be spending some time on this later in the seminar. East plus West. That means that you can combine your favorite Western charting techniques, and I'll show you some of mine, like moving averages, Fibonacci retracements, oscillators, whatever you're using now, you can still use on a candlestick chart. And then add the insights of the candlesticks, the Japanese candlesticks, that is Eastern strategies. And I'll show real-world examples in the Forex market throughout the session. And this works in all Forex markets, in all time frames. Now, most of my charts are going to be, because they're MT4, are going to be mainly Forex. I know MT4 does give you the ability for those who have access to other markets. So keep in mind that candlesticks work not only in Forex markets, but in all markets and all time frames. And what's wonderful about the candlesticks is that they really let you gauge what's going on now, real time, so you could really do analysis of the markets very, very quickly. So, as I mentioned a couple of minutes ago, I will be teaching you about candlesticks, but it's much more than that. We have what we call our trading triad success system. And triad is an English word, or it's actually a Latin word, I think it's derived from Latin, meaning three, triad. And so the three legs, I compare it to a stool with three legs. If you have one leg of a stool, you're going to fall over. If you have two legs of a stool, you might fall over. But three legs give you stability. So we're going to be looking at three legs of the stool here. We'll be focusing mainly on the candle charting, but first leg is candle charting techniques. The second leg, and I made reference to this a couple of minutes ago, is candlesticks plus Western indicators. And the third leg is candlesticks and trade management. But some of you may be brand new to candlesticks, so I'm just going to do this very quickly, going over the basic construction of the candlestick line. The Japanese will say, without oars, you cannot cross in a boat. So I want to make sure we all have the oars. And the candlestick line is made of four components: open, high, low, and close. If the close is higher than the open, this is called the real body, you have a white real body. If the close is under the open, you have a black real body. Now, the high and low of the session, these are called shadows or wicks. Some of you may have a different charting. Instead of a white real body, it might be a green real body for a bullish session. Instead of a black real body, it might be a red real body. Doesn't matter. But what I wanted to highlight is, look at these data points: high, close, open, low. This is really important. As shown on the title here, candlesticks or candles give you twice the information as a bar chart. Why? Why do I say that? Because candles, like a bar chart, will show us the price: open, high, low, and close. But this is particularly important, especially for you who trade Forex. Plus, candles reveal the force of the current move. And what does that mean to your Forex trading? How does knowing the force of the current move help you? The Japanese will say the real body is the essence of the price movement. So let me ask you, who's in charge here? The bulls or the bears? And how do we know? The market opened here and closed there. Right, you're all getting it. Bulls, exactly. The market opened near the lows and closed, in this case, near the highs. So you have a tall, white, real body, opened here, closed here. How do we know it opened here and not down here? Right, because it's a black, real body, so the bears are in control. And the reason I had mentioned a couple of minutes ago the importance of gauging or using the real body to gauge the momentum of a move is because in Forex, unlike other markets, you don't have volume. See, when I use candlesticks in the equity markets or markets that have volume, we could add volume as another indicator on our chart. So we could use volume to gauge the force of the move. We don't have volume in Forex. So this is a great visual way of gauging a force behind the move. So obviously with this tall white candle, okay. So here we have a doji, and a doji in a market means the opening and closing are the same. So here we have an opening and closing. Here's the high of the session and the low of the session. And what the doji means is an equilibrium between the bulls and the bears. And the Japanese will say, and I've had dozens of books translated from Japanese to English, the market is at a point of indecision. Now, what does that mean to your trading? Okay, so here, who's in charge in this tall green candle that I'm highlighting with my arrow? Okay, the market opened there. Exactly, Ermi, right. And closed there. The bulls are in charge. What about this session? It's a doji. The Japanese will say that with a doji, the market is tired. Now, let me give you a word of caution. A doji does not necessarily mean the market's going to go from up to down. You know, we all are looking for the magic candlestick signals. The doji is telling us instead the market's gone from up to neutral. It doesn't mean it's going from up to down. And by that, we know the odds of a market have become greater for a reversal. But if the market, and we'll look at this a little bit later, you could use the high of the doji as resistance. If the market closes above this high here, it's actually a bullish breakout. And I'll look at a chart with that in a couple of minutes. It doesn't mean the market's going to go from up to down. It doesn't mean that you should be doing a bear trade here. It means maybe a time to take profits. If the market starts stalling around the doji, you could think about doing a bear trade. And one of the great things about Forex is, I'm sure you all know, it's as easy to do a bear trade, to sell short, as it is to go long. In the equity markets, at least in the States, I'm not sure how it is overseas, it's very hard to do a short trade in stocks. And what's great about bear moves, a lot of times they will move faster than a bull move, you know, because fear is a much greater emotion or stronger emotion than greed. So here we have a doji, the market's tired. Okay, now I would also view this as a doji, although it's not a perfect doji, but let's look at it in comparison to the prior candles. Bulls are in charge, bulls are in charge. Now all of a sudden we have a relatively small real body. I would equate this, or I'd make this the same as a doji, and that would tell me that the market might be having some problems. Oops. Now this is also a doji, okay, although not a perfect doji, but this real body is so small compared to the other ones. And I also wanted to discuss this. It's a high wave candle. A high wave means it has a long lower and upper shadow. Remember, there's the lower shadow, and that's the upper shadow is the lower shadow. And what this means is that the market, the doji is telling us the market's tired, but the long upper and lower shadow is also kind of echoing that by telling us the market is confused. Because look, the market, and this could be a daily chart, a 5-minute chart, a weekly chart, it really doesn't matter. During this time period, the market rallied, but what happened by the end of the session? It had pulled back. Sometime during the session, the market sold off, but by the end of the session, it rallied to close up here. So it rallies, it sells off, it sells off, it rallies. The market does not know what it wants to do. And that's a market that is confused. And what does that mean? Was the market confused during this rally where each day we had a higher high, a higher close, a higher low? Was the market confused? But here, the market is telling us it's having some problems now. Now we're in a trading range. Now, this may not be bearish, but were we in a trading range here? No, the bulls, we were in a very strong bull channel. Now, all of a sudden, the market's trading laterally in what the Japanese call a box range. So the trend has gone from up to neutral. So you would see that on a bar chart, and you can also see that on a candlestick chart. But now we have the extra insight with that doji. Okay, let me ask you, based on this, these two charts here, we'll call this chart 1 and chart 2. In other words, which doji would you say is more likely to have the market reverse? I mean, we know what happened after, but let's imagine we did not know what happened after this or after this. Where would you be more aggressive, let's say, on a bearish trade, and why? For those of you who said 1, why would you be more confident that the market's going to reverse? Now, when I say reverse, it doesn't mean immediately. It just means, it's going to go down at some point. Okay, so because of doji, number 1, because the price came after a large trend. That's a great point. That's a good point. That's something I didn't even think of, is saying the market moved up so quickly here, it got overbought. In other words, it moved up too far, too fast. And that could be true. The answer is number 1. And the reason for that is, what do you think? What do we have here? Okay, it's confirming a short-term resistance area, right? It's confirming the highs over here. Now, normally, you have 2 highs, the same, it's not a big deal, but you could see that the market is now moved from up to, remember, we don't know what happened here. Is number 1, based on this, is number 2 confirming a resistance area? No. So, based on this, I would be more confident of being bearish on number 1. And this, I wanted to bring this up early because it really echoes the importance of not looking at candles in isolation. But one of the things to keep in mind, and I mentioned here, which is the better short or exit, candlesticks are not only great for giving you entry signals, let's say you imagine you shorted here and have a protective stop over here, but for exiting. So if you were long, this would be a great time to take some profits, because we all are very inclined to let our profits ride. It's just human nature. We just want to hold it a little bit more to get those profits just a little bit more, and this is what happens. How many of us have been in a trade a little bit too long only to have all our profits blown apart, right? Helene is saying, yeah, I believe every one of us. That's true. That's me today. And this is what I mentioned before. I want to spend a couple of minutes on candles and context. So one of the things we bring in our education is not only candlesticks, but how to use candlesticks correctly. There's a lot of information out there on the internet. There are a lot of other services that do education on candlesticks, but remember, I was the one who revealed them to the West. I've spent 30 years with candlesticks. And what I found is a lot of these educators, a lot of this software, and I'll talk about our software in a couple of minutes, are not using candlesticks correctly. They'll see a candlestick signal and they'll say, oh, we have a bullish signal. It's time to buy or time to sell. Now, and by the way, this is one of the quotes I had from one of the Japanese books. To know where you stand is as important as candle pattern recognition. Here we have the master carpenter, and you can see his apprentice obviously did not use the hammer correctly. So we're here to make sure I use the hammer, in other words, the tool of candlesticks correctly. That's why I'm so thrilled that Academy, you know, Admiral Markets gave me the ability to help you discover how to use candlesticks correctly for your trading. So let's look at this. All right, doji and trend. Now, the market's moving up. Is there a trend to reverse? So to me, I view this doji as a warning. A lateral trading range. Let's imagine we have the market moving up and down. This is resistance tested a few times over here and support tested a few times. So the doji is in the middle of a trading range. Is that doji telling us anything new about the market? No, not really, because the doji is telling us the market's undecided. It doesn't know what it wants to do. But so is the box range, right? It's a confused market. It doesn't know what it wants to do. So a doji in the middle of a box range is really not a trading signal. A doji after a rally could be viewed as a time to, you know, take some profits or be short. And then again, with the candles in context, where would you be more aggressive, if you have a doji like this or a doji confirming a resistance area? Obviously, if the doji confirms a resistance area. And so the thrust of this part of the seminar is always look at the candlesticks, but view them in the context of the overall market. Give you another example. Here we have a doji at 1 and a doji at 2. Now, let's think about these doji. And the idea here is I want to take you just beyond the basics. I want to give you a little bit more advanced information. You know, that's why Admiral had me come here today to take you to that next level. So, what's the difference between the doji at 1 and over 2 over here? And let's look at this resistance area. I'll give you a little hint. This resistance area over here. See resistance at 108.45. Okay. But here the market, the doji has closed above this short-term resistance area over here. This doji has not closed above a resistance area. You could use the doji as resistance. So what you do is you take the highest high of the two shadows, in other words, the candle line before the doji, and the doji, whichever one has the higher high becomes resistance. So based on this becomes our resistance area. But let's say we have a doji with an upper shadow that goes to here. That then becomes our resistance. So if you are doing a bearish trade, a short trade, you should use this as resistance. Let me go back to the prior slide and show you. So even if you view this doji as bearish over here, once it closed above it, that is a bullish breakout. And that actually is a good time to do a momentum trade. So there's that doji. And this is a resistance area. So once the market closed above resistance, and what does that mean? That means if it breaks resistance like it does here, you could view this as a momentum, a bullish breakout trade. Now notice here, this is the resistance area because you have the doji here and the high over here. So this is our resistance. You should set a protective stop if you're short at that level there. And notice how the market stalled day after day. This happens to be actually a 30-minute chart. Okay, and there's your breakout. Another Japanese proverb says, it takes the clap of two hands to make a sound. And believe it or not, all the insights we've gotten in this first half hour or so is just based on the real bodies. We're looking at one hand, the real body. We haven't looked at the shadows yet. A tall real body means the bulls or the bears are in charge. So as we saw, the longer the real body, the stronger the momentum. A white real body or a green real body means strong bullish momentum. A black real body, a long black real body means strong bearish momentum. But the relative size and position of the shadow displays the extent of the price rejection. Okay, so we're going to be looking at a candlestick line that has a very long lower shadow. It's called a hammer. And the market has to be in a downtrend. We have a small real body, black or white, that is at least the lower shadow has to be twice the height of the real body. We want to see the market selling off and then bouncing back very strongly. How do we prove a bounce back, a very strong bounce back? By the lower shadow. And the Japanese will say it's a chance to buy at the bottom. And we could use the low of the hammer as a support area. So if you buy on the hammer and the market gets under the hammer, especially on a close, you should be out of the long position. But keep in mind, just because you have a hammer doesn't mean you necessarily should be buying on every hammer. And one of the ways you could tell if a hammer is a good potential buying opportunity or not is using this. What we've done in some of our full-day seminars is we've asked the traders, what are the biggest challenges? We all have the same challenge. And one of them was identifying if support or resistance is stronger or weaker. And if you know support is stronger, you'd be more aggressive on a long trade. If you know resistance is stronger, you'd be either more aggressive on the bear trade or more likely to get out of a long position. And likewise, if you know support is stronger, not only will you be more aggressive on buying, but you'd be more likely to get out of a bear trade, lock in some profits. Where the east-west confirmation comes in. And this is really, really important. Okay, this is one of the things I always look at before doing a trade. One, is there a candlestick signal? And two, does the candlestick signal confirm a Western technical signal? Does it confirm a moving average? Does it confirm a Fibonacci retracement? Does it confirm a support area? Does it confirm an oscillator you may be looking at? Now, one of my favorite Western indicators, I keep it real simple. I like looking at horizontal support or resistance. Okay, I'll look at Bollinger Bands to gauge if the market is overbought or oversold. But let me show you an example of how we could use candlesticks to confirm. Okay, here we have a 15-minute chart. And what I try to do for this special webcast and recording is use all time frames. You'll see 5-minute, 15-minute, 30-minute, daily. I even have a weekly. The only time I really look at weekly Forex is to get a longer-term trend direction or to get major resistance. And here we have a classic hammer. And this one I like a lot. I mentioned before a hammer could have a green or red real body, right, or black or white real body. But I like when it's a green real body because that means the market closed right near its high, right? So here we have a hammer, and is it confirming support? Yes. So would we see the support area on a bar chart? Okay, so I'd actually make this a support zone, the lows here to lows here. So the hammer is confirming support. And what does that mean? Well, if you buy, you know where the protective stop, under the low of the hammer. I'll probably give it, a little bit of a leeway. But this is what I look for when a candlestick signal confirms a Western signal. And you may have your favorite Western signals. You may look at Fibonacci retracements. You may be looking at, MACD. Whatever you use, continue using, and just add candlesticks for your final confirmation. And the opposite of the hammer is the shooting star. Now, because candlestick signals are reversals, that means the market has to be in a short-term uptrend. The market has to be in an uptrend. And we have a white or black real body, and the upper shadow is at least 2 times the height. Remember, the candlesticks are simplicity themselves. They're very simple to draw up, but they give you tremendous insights into who's winning the battle between the bulls and the bears. Okay, so here we have a shooting star, and it's okay to have a little bit of a lower shadow. Just like with the hammer, it's okay to have a little bit of an upper shadow. This is perfectly fine as long as it's a small lower shadow. So this is a classic shooting star. If you're bearish here, I would have a protective stop above the highs over here. Now, okay, this is where we said what candle signal is this? Great. Now the question is, all right, so Inne said, again, if I'm destroying your name, I apologize, says it's a buying opportunity. Okay, so what's your potential target if you buy? What do you think? And again, I should say candles don't give price targets, okay? But I think most of us would agree it would be up here, okay? And where's your protective stop? All right, the lower the hammer. Or actually, I would probably give it a little bit of leeway. I might give it to down over here. But if you're conservative, it would be the lower the hammer. Right, the shooting star would be my target. Okay? And look what happened. Let's say we did buy on this hammer. Okay? This is why we have protective stops. If you were long here and you use the low of the hammer as your stop out area, you would have been out here on the, especially since it closed under support. And not every candlestick signal is going to work. The Japanese have a wonderful proverb, monkeys sometimes fall from trees. Okay? Not everything is going to work out. So having a protective stop is key. Risk avoidance is key. I know it's, and the best time for me anyway to put in a protective stop is just when I do the trade. Because if we have a mental stop and the market breaks down over here, we're going to second guess ourselves and say, oh, well, the market's going to turn and move up. But this is a really important slide to reinforce the importance of protective stops. So the lower the hammer should be a stop out level, and the high the shooting star should be a protective stop. Now, another way to do this is if you want a little bit more bullish confirmation, you could wait for a higher close. Let's say you don't buy on the hammer. You could wait for a higher close the next session to confirm the hammer. What's the downside with doing that? What if you wait for a higher close the next session? What does that mean about where you're buying it? Right, it means you're buying it at a higher price level. So if you're right, you're going to be making less profit, but you've lessened the risk of, or I should say you've increased the likelihood of the trade working out. So there's no right or wrong answer to that. Some people would rather buy here, over here, and have that much profit potential if they're right. Other people would rather have a higher price to confirm the hammer as bullish. They would have less profit potential, but the odds of the trade working out are much higher. Okay, and here's a cartoon. I knew we should have set protective stops. I actually found somebody who draws cartoons for me. He's very good. So I tell him what the concept they want, and he sends me a bunch of cartoons to pick from. So all the cartoons you see here are custom designed for candlecharts.com. Now here's a quote from one of the books I had translated. Combinations of bullish and bearish candle lines indicate the direction of the market, and investors, or traders I should say, psychological conflicts at important turning points. So what the author of this Japanese book is saying is that we should not only look at individual candlestick lines, but we should look at combinations of candle lines. And the first of these would be a bullish engulfing pattern. Now notice here I should say non-4x bullish engulfing pattern. So let me go through that and then I'll explain why I say non-4x or FX. The market's in the downtrend. We have a white real body. And once again, you know, when I say white real body, if your charting system is a green real body or purple real body instead of white, just mentally put that in instead of the white real body in your mind. And in equity markets or non-24-hour markets, the open really has to be below the prior close for this to be a valid bullish engulfing pattern. But because Forex essentially is 24 hours, it's perfectly acceptable for the open to be the same as the prior close. So even if the open and close are the same, or if the open is a couple of pips above the prior close, that is a valid bullish engulfing pattern in Forex. And again, think of this. The bulls are taking over from the bears. And that is normally why in a bullish engulfing pattern, we want to see a small black real body to give us a sense that bears are losing steam, and a tall white real body that means the bulls are really grabbing control of the market from the bears. Okay, so here you can see in MT4 we have the green real bodies, which is the same as white. This is a perfectly fine bullish engulfing pattern. And let me point out something, I'm glad I saw this here. Let me point out something interesting. Notice this white real body wrapping around the black real body. This white real body does not have to wrap around the shadows. It does not have to wrap around the lower shadow. So this is a valid bullish engulfing pattern. See this green real body wrapped around the red real body. Did this green real body wrap around the shadows, the lower shadow? No, right? But it did wrap around the red real body. And the same thing here. This green real body wrapped around, and see how the opening is the same as the prior close? That's perfectly acceptable in Forex. Another bullish engulfing pattern. The point of this is not only is the market confirming a support area, but it's doing so with bullish engulfing pattern after bullish engulfing pattern after bullish engulfing pattern. See that? And in fact, one could have bought after this bullish engulfing pattern. Why could this be a potential buy with this bullish engulfing pattern? Normally, remember I said a candlestick signal by itself, I'd be a little cautious about. But what is this confirming? What is this bullish engulfing pattern confirming? What's happening over here? Right, it's confirming a support area. The low is over here. So let's imagine we don't know what happened over here. Okay, so here you have a bullish engulfing pattern confirming support. And if you needed more reinforcement over here and over here. All right. Now this is an important principle. A candlestick line or pattern requires two criteria. One is the shape of the line or the pattern. So we looked at the hammer, we looked at a bullish engulfing pattern. And two is the trend. Remember, we talked about, remember a hammer has to come after a downtrend. A shooting star has to come after an uptrend. Okay, a bullish engulfing pattern, the market has to come in a downtrend. That's what these down arrows are showing. So with this in mind, here's a green wrapping around a red. And notice I put not a bullish engulfing pattern. Why is that? Right, the trend is wrong. A bullish engulfing pattern has to come after a downtrend. This was during an uptrend or at best a lateral trading range. So this is not a bullish engulfing pattern. Okay, now we looked at the bullish engulfing pattern. Now we're going to looking at the bearish side, the bearish engulfing pattern. Okay, non-Forex, a bearish engulfing pattern in a non-Forex market. The black real body wraps around the white real body. And in non-Forex, in stocks and so forth, in equities, the open has to be above the prior close for this to be a valid bearish engulfing pattern. In Forex, not surprisingly, it's okay for the open to be the same as the prior close. The market has to be in an uptrend. Remember, this is a bearish signal, so we need a trend to reverse. And the Japanese will say the bulls have been constrained. That is, the bulls have taken over from the bears. So let's look at this. This is a bearish engulfing pattern. Okay, red wrapping around the green. And a little bit of an uptrend, so that's valid. And notice again, this red real body, all it had to do is wrap around the green real body. The red real body did not have to wrap around the upper shadow. All that has to happen is real body wrap around real body. You see that? Okay, another little bearish engulfing pattern here. I just noticed a little bit of a rally. Bearish engulfing pattern over here. And bearish engulfing patterns, like a lot of these candle signals, become resistance. So here we have a bearish engulfing pattern. Becomes resistance right around 127.20, right over here. This bearish engulfing pattern, you take the highest high of the two candles in the bearish engulfing pattern, becomes resistance, so the resistance level would be right over here. Okay, why is this not a bearish engulfing pattern? Here we have a red wrapping around a green. Why is that not a bearish engulfing pattern? No trend, exactly, or a downtrend, right? Or you could view this as a little bit of a downtrend. Remember, a bearish engulfing pattern has to come after an uptrend, even a short-term uptrend. Now, notice this. Here we have a red real body that does not quite wrap around the green real body. It gets deeply into it. This is actually called a dark cloud cover, and we're going to look at that now. So the market opens, we have a rally, we have a white real body, the market opens at the prior close on this session here within a few pips, and notice this dashed line here, this dotted line, the close has to be more than halfway under the white real body. See, if this black real body wrapped around the white real body, that would be what? A bearish engulfing pattern. But if it gets more than halfway under the white real body, it's a dark cloud cover. And this is what this is, a dark cloud cover. And what's interesting is this dark cloud cover confirmed the resistance area. Okay, so here we have a classic dark cloud cover. And you can use the high of the dark cloud cover as resistance. Okay. And so let me go back here. So the high here would be a resistance area, which was confirmed the next session. This one's interesting. Here we have a doji, right over here. Why would you not be too bearish on that doji? Remember the concept of candles in context? Where's the close of this doji? Right, it's right. It's closing. First of all, it's a higher high. We're still making higher highs and higher lows, and the close here is same as the prior high close. You know, if the close was lower, then I'd be a little bit more nervous. All right. So something like this here. See, the close here is under the close here. This small real body I would view as a doji. It's a lower close. So I'd be more confident of a reversal. Here, we're still making higher highs, higher lows, and we're holding the high closes. So again, the idea of candles in context. You could have doji, but how you trade with the doji is going to be very different based on the overall market condition. Here we have a shooting star, dark cloud cover as resistance. Now, this dark cloud cover is as resistance, but what is it also confirming? So this dark cloud cover might be a potential great short sale because it's confirming resistance. And of course, you would have the protective stop above the highs over here. Now, the opposite of the dark cloud cover is the piercing pattern. The market is moving down or moving south. And then we have a white real body that gets more than halfway into the black real body. And again, if the white real body was bigger and wrapped around the black real body, what would it be? A bullish engulfing pattern, right? So, but if it gets more than halfway into the white real body, the bulls have intruded deeply into the bear's territory. And the Japanese will say that it's a hint that the decline is exhausting itself. So here we have some signals with NCH. Okay, we have a bearish engulfing pattern, we have a dark cloud cover, and a piercing pattern. And the reason I wanted to show you this is because notice the dark cloud cover, the piercing pattern and the dark cloud cover are the opposite. Okay, so if you, let's say you sold in this dark cloud cover over here and you had a protective stop here, the first sign of the market bottoming out via candlestick signals was this piercing pattern. So if you sold here, you could have taken profits over here. On the flip side, if you bought here, I probably would not because this pierce pattern is not confirming support. But let's say you look at Fibonacci retracements and let's imagine, going back, let's imagine we had a big rally and you have a 50 or, 38 or 61% or 62% retracement, and you have a piercing pattern confirming a retracement level, that might be a reason for you to buy because you like using Fibonacci. So if you bought on the piercing pattern, my target would probably be anywhere around here, the high of the dark cloud cover. So I might have taken profits a couple of, let me see, this is a couple of sessions later. Okay, so you sell here and you could take profits there. Okay, candles as support. So here we have a piercing pattern as support. And I would also take a low here. So let's say we buy here. And I would view this as a hammer. The upper shadow, yes, is a bit of an upper shadow, but it looks like 10% or less than the lower shadow. You wouldn't even have to wait for the close of the session here. You could think about buying when the market gets here. A lot of nuances, don't have time to get through. But one of the downsides of candlesticks is that you have to wait for a close. So by the time you got the signal, it would be over here. But one of the things you can do, if during the session here, this is a daily chart, during this time here, during the day, if the market gets anywhere near here, you could be buying it here, and you could have a protective stop here. So what that's letting you doing is you're buying it here. You have a less risk because you're buying it here, and your stop is here. Nothing wrong with buying it here, but now your risk is all the way down here. But here you have the main thing is you could use a lot of these candlestick signals as support or resistance. So the piercing pattern as support and the low here, and my target would just be the recent high. Your target might be something completely different. I like looking at prior highs and prior lows, so this would be my target, and I'd be taking profits either here or on this shooting star. Okay, you may want to lock in profits here. Why would you be a little nervous here? What candlestick signal is this? It's not quite a bearish engulfing pattern. What is this? Remember when the black, right, good call on that, Sanchi. Right, Cataline, and many others who I'm not even going to try to pronounce your names. Dark cloud cover, exactly. So nothing wrong with taking profits there. Now, the Japanese have a wonderful proverb. They say, without practice, knowledge without practice makes but half an artist. So what I've done is, I'm just laughing at a comment somebody made. What I've done is I've made a chart challenge. So what you're going to do is name the candlestick signals at 1, 2, 3, and 4. And for those of you who are watching this on a video, just put the player on pause and think about the answers, and then you will hear the answers. So what's number 2? And actually, this is a chart we saw before, but now we're kind of to reinforce what we learned and to kind of cement into your memory some of the patterns we talked about. Okay, number 2. Cataline, right? Right, 2 is a dark cloud cover. Great. Okay, number 1. And it's a little bit of a lower shadow, and it's a white green candle, but it doesn't matter. Right, great. Good call on that. Shooting star. Number 3. Okay, with a green body, and it does get more than halfway into the red body. Piercing. And number 4, it's a black real body wrapping around a green real body. So we're looking at number 4 now. The red wrapping around the black. And many of you are saying a bearish to new, right. It's not a bearish engulfing pattern. And somebody got it right. The names are going by so quickly. Correct. It's not a pattern. It's not a signal. Because remember, for a bearish engulfing pattern, for the red to wrap around the green, that's part of it. What else does it have to be? What kind of trend has to be before a bearish engulfing pattern? Remember, it's a bearish reversal, an uptrend. Exactly. And so let me show you the answers based on NCH, Nissen candle highlighted. These are the signals with abbreviations. So you can see DC is a dark cloud cover. S is a shooting star. P is a piercing pattern. And notice there's nothing here. It doesn't say bearish engulfing pattern. Why? Because the trend is wrong. And what we do with NCH, the Nissen candle highlighter, is we take into account trend. Now, we talked about candlestick charting. We touched a little bit about Western technicals, but now I want to talk a little bit more about candles and Western technicals, the second leg of our trading triad. So here we got a nice quote from one of our students in Germany. Proper identification of support and resistance areas together with price and candle pattern analysis is the first and most important step towards successful trading. And I totally agree with that. So let me show you one of my favorite Western strategies in combination with candlesticks. Now, I had mentioned that I like just using prior support and resistance. Indeed, I do. But let me show you one of the patterns I like working at with candles. The Japanese, as I think I mentioned in one of the other charts, a lateral trading environment or a trading zone, the Japanese call it a box range. So that's where resistance is tested twice and support is tested twice. So when the market fails from the top end of a box range, what's great, especially with a candlestick signal, what's really good about that is we get a target. Where's the target? The recent low, the bottom end of the box range. Same thing here. If we're in a box range, remember it has to be tested twice here and at least twice here. If the market has, say, a hammer or a bullish engulfing pattern or one of the other patterns in NCH like a bullish Hadarmi or, you know, a piercing pattern, we can think about buying it, of course, with a protective stop, and our target is the recent high. So here, for example, nice box range. Okay. So here the market successfully tested the bottom end of the box range. And here it stalled. Where did it stall here? With a shooting star and a bearish engulfing pattern, right? So the target is the bottom end of the box range. Everybody see that? Here we have a failure of resistance, and my target would be over here. We might have a little minor support here, but this support is my target. Now, one of the other great things you can do with a box range is once the market breaks out of a box range, because I'll show you, whoops. Okay, so let's say here's the box range. And once the market breaks out of the box range, you could take the height of the box range and add it to the breakout. So that would give you your upside target. All right, everybody see that? It's a measuring target. And the opposite would be if the market, let's say we're in a box range here, and say, you know, the market, it should be support. But if the market closes under the bottom end of the box range, you then have a downside target. You take the height of the box range. This is one of my favorite measuring targets. And the reason I wanted to show you that is because on the next slide here, notice what happened. The market closed under the bottom end of the box range. So what I did, and I'm not, you know, I did this a little while ago, so I'm not sure if we reached the target or not, but I took the height of the box range and subtracted it from the bottom of the box range, and this becomes my target. So if it broke on the top, above the top end of the box range, whoops, if it broke above the top end of the box range, I would do the opposite. I would take the height of the box range and add it to the breakout. Okay. That's true. By the way, this is not a hammer. The upper shadow is too long. But if this was a hammer over here, as soon as the market closed under the low of the hammer, you should be out of long position. Is because if we have a multi-tested support area, and what I mean by multi-tested, it has to be tested at least 2 times. We know the support, hopefully, if you're bullish, should hold. If the market breaks under that support, okay, let's say you bought at support, you know, let's say you bought here, you're thrilled because the market tested it many times, you congratulate yourself, then the market does this. Okay, congratulations, you bought at support. Would you still be happy you bought up here? You probably feel like this, right? The market breaks support, you're long under a broken support area, and you're just hoping and praying that the market comes back up for you to get out at break even. So based on that, this is one of my favorite trading strategies to find support or resistance, is what I call change of polarity. And this is a very common Western signal. Once old support is broken, that old support becomes resistance. And think about, you know, this technical analysis, whether it's candlestick charts or even bar charts, have valid psychological reasons why they work. And here's a case in point. Anybody who bought here or here or here or here, once they buy here, are now losing money. Wouldn't you and they be thrilled to get out at break even if the market came back? Right? So all the buyers here become what here? All right. And same thing here. Once the market breaks out, the old resistance area, if the market is good, should become a support area. And this is how I trade momentum. If the market breaks above a resistance area, if I buy on a breakout, my protective stop is under the prior resistance. If I do a bearish trade, if the market breaks under support, my protective stop is under the prior support area. Because if the market is weak, once the market breaks support, it should not get back above the broken support area. If the market breaks above resistance, it's up to the bulls to keep the market above that resistance area. If they fail to keep above the resistance area and it pulls back here, that's a false breakout, and oftentimes that could be very, very bearish. Okay, recently in the U.S. Canadian resistance area, bearish engulfing pattern is a classic bearish engulfing pattern because the market was in an uptrend. Resistance, see, it has to be tested, the resistance has to be tested a few times. Resistance, resistance, resistance. Once the market closes above that, one could think about buying it with the idea that the prior resistance should be the new support. And now that I see this, let me show you something here. Make this a little thicker. Okay, let me go back to the full screen. Now what do we have here? Here and here. What's here? What were we talking about? One of my favorite trading strategies? Right, a boxed range. So now the market broke above it, how do you get a target? You go from the low of the box range here, let's say over here, to the high over here. So you take this distance, whatever it is, looks like a couple hundred pips, but whatever the distance is here, from here to here, and you add it to the breakout to get an upside target. Now, it doesn't mean there's not going to be any resistance. You know, let's say we had resistance over here. Let's imagine, you know, I don't have the charts going back here. It doesn't mean you don't take profits there, but this gives you a price target, box ranges. And so once he broke above the resistance, the old resistance became new support. And on the flip side, if the market broke under the support area, what should become new resistance? Right, the old support. Okay. Change of polarity. Again, recently, this is actually a weekly chart. It was an important breakout in the pound dollar. This resistance area, it's a little hard to see here, but these two blue lines, major breakout here. And for those who follow the pound dollar, it's very important, especially on a weekly close, to hold above this change of polarity. Because now the market's broken out of this long-term resistance area, this old resistance must hold as new support. Okay, let's do another chart challenge. Keep you awake. Okay, number one. Is this a bullish engulfing pattern? It's a green, and I don't have this in candle highlighter on here, so green wrapping around the black. Great, you're all getting, but good, good. Well, it's a real compliment to you that you're picking this up so quickly. Everybody is saying no. That's great. Yeah, because we need trend. Remember, it has to be a downtrend. Like this would be a bullish engulfing pattern here. Why? What was the immediately preceding trend from this dark cloud cover? Down, right? Over here. And another little clue, the bears are losing steam here, not only the small real body, but the long upper and lower shadow. Remember we talked about the high wave candle showing the market's confused? Was it confused going down? No. So here is a sense of confusion. The trend has turned from down to neutral, and this turns it short-term bullish with the bullish engulfing pattern. Okay, now the question is, what are 3 reasons to be selling here? Okay, the bearish engulfing pattern, correct. Okay, it's a red wrapping around the green. I'm really impressed most of you got this because, you know, many times we'll forget about this. We're so focused on candles. But yeah, you're all getting it. It's confirming a resistance area. Great call on that. That's really, really important. And of course, the third reason is a shooting star. But to me, a key factor, a major factor, yes, beside the multiple candlestick signals, which are great, and actually this bearish engulfing pattern is confirming the shooting star's resistance, so that in itself is great. But look at all the resistance going back. And this brings out an important point. Not only, you know, look at what's happening with the candle signals, but look at what happened, you know, prior to these candlestick signals. Are you near a major resistance or support area? So great call on that one. And now we'll look at the third leg, vitally important. Once again, I could spend hours on trade management, just as I could spend many more hours on Western technicals and candles. But my goal here is to kind of give you a snapshot with some advanced strategies on how to correctly use candlesticks. And a key aspect many traders do not take into account is trade management. And the most important rule, and I think in the announcement that Admiral had on their website is, you know, Steve's most important trading rule. This is it. You ready? Okay. Risk reward. a candlestick signal or a candle signal, even if it confirms other indicators, is not enough of a reason for a trade. You must always consider the risk reward. So in other words, if you have a hammer, or here, let's go back here, multiple bearish candlestick signals, okay? Shooting star, bearish engulfing pattern, confirming resistance. Another thing you have to take into mind is you have to think about the risk reward. And we know the reward part is your potential profit, okay? What is your target? You know, and your target might be different than mine. Candlesticks, yes, they can give you times to enter or to exit a trade, but before you put the trade on, you have to think of what a potential target is. To me, I look for the nearby resistance. And risk is what your potential loss is. All right, so we know what risk reward is. So let's look at this. Which is the better short trade, 1 or 2, and why? And these are both dark cloud covers. There we go. And by the way, look, what do we have over here? A doji. And notice how the doji became resistance right over here. But anyway, so think about this. Dark cloud cover 1 and 2. And remember what we were just talking about, risk reward. Right. So what do you think would be a very reasonable target with dark cloud cover 1? And can you read the numbers? What do you think would be a reasonable target? Let's say we have a dark cloud cover here. Would this be a reasonable target? Yeah, I think so. All right. What the correct answer is. Okay, so let's make that our target. And let's think about the risk reward. All right. Okay, so if we shorted on this dark cloud cover, that is our stop out level. Okay, everybody agree with that? And our target would be here. So that's less than a 1 to 2 risk reward, right? I mean, it looks like to me you're risking more than your potential target is. So this is a trade I would potentially stay away from. Whereas a dark cloud cover here, this is your risk level, your stop, correct? And this is your target. Does that look like a good trade? Yeah, I think so. And this is a great example of how you could have the exact same candlestick signal, in this case, dark cloud covers, and you would trade completely different on them. And this is what our education is all about. It's not just learning about the candlestick signals, it's, you know, what to do with them. So by getting this education, you're going to be so many light years ahead of other traders to know how to use the Nison candle highlighter. Because, again, I don't have Nison candle highlighter on here, but these would be both picked up as dark cloud covers. But now with this education, with this idea of risk reward, you would know, hey, NCH picked up a dark cloud cover. I think this looks like a good short sale. It's confirming resistance, and there's a good risk reward. Here, yes, the dark cloud cover is confirming resistance at the doji, but it's not a good risk reward. So this is something to take a trade on. And let me ask you something else here. Okay, here we have a doji. Now, let's think about risk reward. Would you think about shorting on this doji? Okay, what would your target be? I know what my target would be. I think, you know, I'm thinking down here, right? The recent low. Once again, you may have another target. So yeah, I would think my target would be down here. Let me do another chart challenge, and then let me give you the information about Nison candle highlighter again, because a lot of questions. Okay, so what bullish candlestick signal is this? Question number 1. Based on this signal, would you buy, why, or why not? And most of you are getting this correct. It's a hammer. Would you buy, why, or why not? And this is a little bit more advanced because we talked about, you know, one of the key points, remember old support. Right, exactly. It broke a support area. Right. Great, you're all getting it. Super. Boy, I just want to compliment Admiral for having such astute students. I'm really impressed. Exactly, it broke a prior support area. And here, look at close or resistance. Do you buy? So in other words, it's a bullish breakout. Over here, do you buy? So we had the resistance at the doji. It closed above it. Okay, do you buy? And then we'll look at the answers. And the answer is no. Why not? If you close above the resistance, isn't it close above resistance? Right, exactly. So the answer is, look at this, where this resistance is over here. So if you buy here, right, and your target is up here, and the stop out level, I'm not sure where the stop would be. I'd probably make it over here. It's not a good risk reward. So yes, you could break resistance above the doji, but you have to look at the prior resistance to see if it's a good risk reward. And you all got it correct. Change of polarity. Prior support, once broken, which this hammer did, becomes resistance. So if you buy this hammer, you are actually buying at a resistance area. Right? When would you think about buying on this hammer? What would have to happen? The next session, or 2 sessions after. What would give you bullish confirmation of the hammer? Right, Brian, exactly. We have to see a close above this broken support area. Remember, prior support becomes resistance, because that would mean that the market broke a support area. So good call on that. So, hope these chart challenges really got your brains working and helped cement and, what we learned. And so thanks for joining me, and may the candles continue your light to profitable trading.